Hey, good morning, everybody. It's Aaron. Today is Tuesday, April 7th, 2026. I, of course, am here with your market update. My name is Hammer. I am the founder of Originator Success, Grab and Go Social, and Rate Sensei. You can join me live each and every weekday morning, 9:30 a.m. Eastern Time on Facebook and YouTube as we talk about what's going on with markets, rate, and pricing, all that good stuff. So if you're here this morning, say good morning. Let me know you're here. If you're watching on the replay, do me a favor. Just give me hashtag replay in the comments. Let me know that you were watching in the future from now. So if you would like a reminder that I'm going live so you don't miss a moment of the show, make sure you sign up for our text reminder. It goes out each morning as I go live. It gives you the links. And there is no nefarious purpose. I don't sell your information. We don't sign you up for trigger leads. hmmr.io/reminder or use this cool QR code. And I'll give you a heads up as I'm going live each morning so that you don't miss a moment of the show. Also, you can sign up for our free daily email lock at advice at www.ratelockadvice.com. You can also sign up for our text alerts at www.ratetextalerts.com. Those are $7 a month. It's a great service. You should absolutely check it out. So, all right, my friends, let's go ahead and say hi to all the live folks here this morning. Welcome to everybody. Harry Dennis, Deb Dickinson, Dino Clathis, Megan Bissell, Eric McDonald, Tim Clio, Rob Wilson, Randy Tico, Giddy Up, sir. Great to have all of you here. Let's see who else I might have missed in the meantime. Sean Segaloff, good morning, sir. Mallory Fodiatis, good morning. John Melnick. Good morning, Zane and Ms. Amy Blauser. Great to have you here. All right. So let's go ahead and let's just jump right in today. I got to tell you, my knee feels great. My sciatica is killing me. Oh, my knee replacement has just brought on a killer case of sciatica. For anyone that is familiar with that, your sciatic nerve runs from your lower spine, your lumbar region, basically top of your ass, down through your butt cheek, down below through your thigh, and down behind your knee. And man, I am like a flea on a hot brick this morning. I cannot get comfortable. I have just a brutal stabbing pain going up my leg and my back. So anyway, enough whining. We got to get into it, but that's why you see me moving around so much and dancing on the screen. So let's start off with a quick recap. What happened yesterday? Yesterday, we saw a great start to the week. Mortgage bonds actually jumped up and improved through the morning. And if we take a look at this, let's do the 5 days just for a minute so we can see that, right? So here we ended the day on Friday. This line is because it's the difference from where we ended on Friday after markets closed for the holiday weekend and where we started on Monday. So you could actually, we started low, but we ticked right back up. And what we've basically done is we've gained more ground. We're right back where we were on Thursday before the jobs data. Remember, Friday, this big drop, this was the jobs data right here. Jobs came in stronger than expected, but bonds have shrugged that off now. So this morning, we're down about 2 basis points on the day. That's basically going to put us the same as pricing as where we were at yesterday. Maybe a little bit better for some, but generally we're going to be right about the same levels here. You could see not too different here, not too far off. So rate sheets today should be similar to yesterday. Some lenders maybe a little bit better. Reprice risk on the day is moderate. We are not seeing the volatility that we were seeing a couple weeks ago. Markets have kind of come to terms with this, but we do have the potential for some volatility. Overall, rates are generally looking better, and I'll stick with where I was before. How long will it take for them to recover? Now, today, of course, is the deadline. But we have had the deadline a few times already. So I don't think markets are overly concerned. I don't think markets are really pushing any flight to safety. We're not seeing bonds improve this morning on this idea that that we are going to, go ahead and attack. So, but there is, I think it's 8:00 this evening is the deadline. So Donald Trump escalated threats to Iran after setting a deadline for a deal, including the reopening of the Strait of Hormuz by Tuesday at 8 p.m. It was Monday at 8 p.m. Before that, it was last week. So we've seen it already pushed back out. Trump said a whole civilization will die tonight, never to be brought back again. Again, that's the Trumpism. I know that they probably picked one of the more inflammatory comments, but he makes many of them, so it's easy to do. But, again, we don't know how this is going to play out. Trump could just push this. That's one thing about Trump that is very different than anybody else. He doesn't run back and defend what he said or changes that he makes. So he can make changes on the fly anytime he wants. So, we could be in the middle of the day today and he may say, oh, we're having really, really great talks. A couple of ships have gotten through the Strait of Hormuz. So we're going to go ahead and give them till Thursday at 8 p.m. Who knows? So there's not really a lot we have to worry about here that it's going to cause a definite jump in bonds. Now, what happens if we do actually see escalation tonight? What if we see boots on the ground? What would that do? I think we'd actually see bonds improve on that news. We have absolutely seen a decoupling between mortgage bonds and the price of oil. Oil, as oil goes, it was for a while. If oil went up, rates got worse. If oil improved a little bit, rates got a little bit better. We've seen oil gravitates. It's kind of stabilized around that 110-ish area. And unless we jump over 120, I'm not really concerned that if oil goes up, that bond prices will lose a bunch of ground. So when we look at pricing, we really do seem to have capped out right around here. This was that worst day, 6.64. We've come back down to below 6.5 on the Mortgage News daily rate sheet using, their parameters. The key here isn't necessarily that this is what the rate is. It's more of what variation have we seen, consistency to it. If we use the Optimal Blue, they're saying rates are at 6.33 today, but that also includes points and fees. So that's the difference there. So overall, again, low sixes, not really terrible. If we do see an escalation, it doesn't mean that we have to worry about necessarily seeing things go nuts, but it also doesn't mean that we'll see rates that are going to benefit in a true flight to safety. This is an already ongoing saga. Couple of things to keep in mind, one of which is the capital goods came out this morning, capital goods orders from February. U.S. orders for business equipment rebounded in February, suggesting companies were moving forward on investment plans before the Iran war. This is just stuff to pay attention to, even though it's not moving markets this morning. We really have to question, is there a concern that we're going to see a lot of increase in inflation because of oil prices being higher now, or will we just see this kind of flow through the system, a shock, right? So far, it looks like the second case, that we're not going to have to worry about seeing inflation numbers that would continue to rise higher, which would cause concern about rate hikes. Remember, Fed rate hikes were a concern earlier on, now not so much. If we look, this is December, there's 12% expectation of a rate cut and only 7% expectation of a rate hike. We've seen this vacillate, and at one time, all the idea of any rate cuts disappeared in favor of possible rate hikes. So, but the other thing here, stocks drop as caution grows before Iran deadline markets wrap. Was that the article that I wanted, though? Or was this one? No, it was this one. Some Republicans set their own deadline on the Iran war. It's getting close. There's an argument about after the Vietnam conflict, which now they call it, here in this article, called the Vietnam War. I was always told it was the Vietnam conflict. Congress passed the War Powers Act, overriding then President Nixon's veto. The law mandates the president notify Congress within 48 hours of deploying U.S. troops. And after 60 days, the military operations must be terminated unless the Congress votes to declare war or pass legislation to authorize the use of force. So we're coming up within the 60-day window towards the end of this month. And, there is argument about what would happen if we got there and where would we be. Trump himself has avoided the use of the word war. And, he said, I won't use the word war because if they say if you use the word war, that's maybe not a good thing to do. They don't like the word war because you're supposed to get approval. So I'll use the word military operation, which is what it really is. So, and that's why I've been calling it a conflict, because we have not declared war and it has not been a war. So anyway, this is some stuff that we've got. Again, markets are watching all of this to see, are we close to an end? And the answer, markets believe we are. That's all that really matters, right? Markets believe that we're still close to an end here, and we'll see. We'll see where it goes. So this evening, if we do attack, we could see volatility in rates. It wouldn't be a huge difference, but it could be some. Keep that in mind. And it could possibly create more improvement. We could see a true flight to safety. That could shake up stocks and push money into bonds, because markets have seemed to have come to grips with where oil pricing is right now, and not necessarily that it's going to drive up inflation long term. So that's why we saw that initial negative reaction, because oil prices went up because of fear of inflation. So now we've seen that kind of roll back. But anyway, I hope all this helps you. Ron Siegel says today, let's see what you guys have to say. When you see Vietnam referenced as a war, it tells you the bias of the author or the periodical. The last declared war in the U.S. was World War II. Exactly. Yeah. Thank you for clarifying that. I agree. Oil creates short-term inflation, but long-term economic slowdown, which might help inflation and might help rates, as Ron knows. So trouble on the bond front when looking at the ADP weekly job numbers. I'm late, so you might have already mentioned it. No, I didn't mention it on the weekly ones. I didn't even pull them up. Why did they come in stronger than expected? But again, bonds are still only down. Oh, I see. They're down 12 basis points now. Let me go ahead and pull this up and we'll show what Ron's talking about. There we go. Here you go. So if we take a look at this, right now, bonds have lost a little bit of ground here because that ADP data that came out, probably coming out showing stronger than expected jobs. And we're seeing that negative reaction. We were down 2 or 3 basis points. Now we're down 12. But give it a minute. It'll rebound. I don't think we have to really worry about anything there. So 10-year Treasury yield, 4.36. Again, still holding steady. Look at this consistency that we've seen really in the face of everything going on. So pretty good to have. Robert said, isn't inflation driving the bond market? It's definitely one of the components, but it also depends which part of the bond market. You've got your short-term bonds, short-term yields, you've got long-term. So inflation will have more of an effect depending on how someone is trading, what they're trading for, and, how long that perceived inflation is expected to hold for. So, all right. Well, there you go, my friends. So we'll see. We'll see if tonight ends up being the final deadline. I don't know that it is. I don't know that it isn't, but I don't know that it is. But be ready. It could cause some volatility in the morning. Lock accordingly if you are concerned about that. Otherwise, rates have stabilized. Thankfully we're in an environment where we really did not see them push as high as I thought they could have gone, and hopefully they don't. We'll see if as continued escalation goes. ADP weekly average 26,000 for the past 4 weeks, previous 10,000. Yeah, so that's more jobs. I'm getting a little bit more back to myself today. Thank you. Yeah, Ron, I'm trying. So, but this morning I'm just whining because I'm in a lot of pain. So, from sciatica, not even my knee. My knee feels great. So, all right, my friends. Well, thanks again for joining me. I will see you tomorrow. We'll see what tomorrow brings. We'll look back and see if it really was the day of the deadline or if that deadline got pushed, what effect that it has on rates and pricing. There's no other stuff that we really have to worry about having a surprise tomorrow with pricing. Anybody that's closing a loan farther out has less to worry about. If you got stuff closing near term, there's always a potential for things to swing right now. So you've got to lock according to risk. So, all right, my friends, I'm going to wrap it up. Thank you again. Have a great one. Bye-bye.